Hello, and welcome back to Market Brief After Hours. It feels like the markets finally exhaled today. After a week that felt like a roller coaster ride of geopolitical headlines and trade threats, Thursday brought a distinct shift in the atmosphere. We saw a sea of green across global equities, and it seems like investors are finally looking at the fundamentals again, rather than just reacting to the latest political soundbite.
It really was a classic relief rally. The headline risk that has been hanging over the market like a dark cloud just evaporated, or at least it moved far enough into the background to let buyers step back in. The catalyst, of course, was the de-escalation in trade rhetoric. The U.S. president decided to pause those proposed tariffs on European nations, and we also saw some positive movement regarding the status of Greenland. That allowed the market to pivot back to what really matters, economic data. And frankly, the data we got today was stellar.
It's the kind of data that makes you wonder why we were so worried in the first place. Let's start with the big picture in the U.S. We saw a significant recovery in the major indices.
Absolutely. The selling pressure lifted and the buyers rushed back into technology. If we look at the numbers, the S&P 500 recovered nicely, adding 0.55%. It settled at 6,913. It's interesting to note that this move was really driven by those mega-cap tech names, which had taken a beating earlier in the week.
And the Dow Jones Industrial Average had a very strong showing as well.
It did. The Dow gained over 300 points, 306.78 to be exact. It finished the session at 49,384, up 0.63%. That's a significant psychological win, because the Dow is often more sensitive to those trade war narratives. Seeing it bounce back suggests that the industrial sector is breathing a sigh of relief.
Then we have the tech-heavy Nasdaq,
Leading the pack, as it often does on risk-on days. The Nasdaq Composite gained 0.91% to close at 23,436. This was all about the Magnificent Seven and the broader AI narrative. We saw favorable analyst commentary on AI leadership, and investors didn't need much convincing to jump back into those trades.
You mentioned the economic data earlier. It wasn't just the absence of bad news, it was the presence of surprisingly good news.
Exactly. The U.S. economy is showing incredible resilience. We got the revised third-quarter GDP figures, and they were revised upward to an annualized rate of 4.4%. That blew past previous estimates. When you combine 4.4% growth with a labor market that refuses to crack, initial jobless claims held steady at 200,000, you have a very strong foundation.
And what about inflation? Usually when growth is fat hot, the worry shifts to overheating prices.
That's the Goldilocks element of today. The Federal Reserve's preferred inflation gauge, the PCE price index, rose 2.8% in November. That matched expectations. It tells us that while inflation is still above target, it isn't re-accelerating. It's stable. That stability allowed Treasury yields to calm down. The 10-year yield was essentially flat at 4.251%, and the 30-year actually fell a couple of basis points. The market is comfortable with this level of growth as long as inflation stays in its lane.
Let's look across the Atlantic. The tariff pause must have been music to the ears of European investors.
It sparked a significant rally. The pan-European Stock 600 climbed 1.1%. The threat of tariffs on 8 European nations was removed, and you could see the immediate reaction in the major bourses. Germany's DAX 40 rose 1.2% to 24,876, finally snapping a 4-day losing streak. In Paris, the CAC 40 gained 0.99% to close at 8,149.
And London?
London participated, though a bit more modestly. The FTSE 100 edged up 0.12% to 10,150. There was some domestic political speculation widening gilt yields there, but the mood was generally positive. Interestingly, we saw a massive surge in Volkswagen shares, up 6.2%, thanks to a 20% jump in net cash flow. That helped lift sentiment across the region.
It seems like the relief wasn't just confined to the West. Asian markets also had a strong session.
They did. The retreat in U.S. tariff rhetoric is a lifeline for export-heavy economies in Asia. Japan's Nikkei 225 surged 1.73% to end at 53,688, ending a 5-session slump. South Korea's Kospi was up 0.87%, despite some worrying data about their economy contracting in the fourth quarter. It just shows how powerful the sentiment shift regarding trade really was.
Before we dive into the technicals of the currency markets and some individual stock movers, let's take a quick break. Welcome back. We've covered the equities rally, but there were some massive moves in the currency markets today. The dollar seemed to soften quite a bit as that safe haven demand unwound.
That's the main theme in Forex today. Dollar weakness. As the fear subsided, money moved out of the greenback and into riskier currencies. Let's look at the euro. The euro-USD pair reclaimed some very significant technical levels. It closed at 1.1748, gaining 0.55%.
And looking at the charts, that move seems to have broken through some resistance.
It smashed through them. The pair decisively cleared both the 50-day SMA at 1.1664 and the 100-day SMA. Those levels now transition from being ceilings to being floors, dynamic support. As long as the euro stays above 1.1700, the outlook is bullish. The next target is that psychological barrier at 1.1800.
The British pound also had a standout day.
It did. GBP USD surged beyond 1.3400, settling at 1.3496, up 0.48%. The key technical development here was the breach of the 200-day simple moving average at 1.3408. When price crosses above the 200-day SMA, it often signals a resumption of a medium-term uptrend. We're also seeing the 50-day and 100-day averages starting to slope upward, which provides a nice tailwind for the pound.
On the flip side, this franc lost ground against the dollar. Or rather, the dollar lost less ground there. No, actually, looking at the data, the USD CHF dropped significantly.
Right. The pair dropped 0.72% to close at 0.7896. This is a case where the franc strengthened. The pair has fallen well below its 50-day and 100-day SMAs, which are sitting up near 0.7979. Those are now overhead resistance. The trend here is clearly bearish for the pair, targeting the prior swing low at 0.7850.
And for the Aussie dollar?
A breakout performance. AUD-USD surged 1.15% to close at 0.6838. It blew past its 50-day SMA at 0.6627 and the 200-day at 0.6537. This is a robust breakout from consolidation. We are in price discovery mode now, looking for higher highs.
Moving to commodities, we saw a divergence between energy and metals. Oil prices slid while gold and silver rallied. Why the drop in crude?
It goes back to the geopolitical situation. Oil had a risk premium baked in the price because traders were worried about supply disruptions. With the U.S. administration taking a more diplomatic tone on Greenland and Iran and that NATO framework for the Arctic, the fear of immediate supply shocks faded. Brent futures settled at $64.06, and WTI fell to $59.36, dropping about 2%. The market is recalibrating toward that $60 threshold.
But gold and silver didn't get the memo that fear was subsiding. They skyrocketed.
That is the fascinating anomaly of the day. Usually when fear eases, gold drops. But we saw gold hit new multi-month highs, climbing 1.83% to settle at a staggering $4,921. It's trading well above its 50-day SMA of $4,334. The previous resistance at $4,500 is now major structural support.
And silver?
Silver went parabolic. It closed at $96.14, up 3.26%. It even peaked at $96.58. The moving averages have been left in the dust. The 50-day is way down at $67.09. This is an explosive long-term uptrend accelerating. It suggests that while immediate geopolitical tension eased, there is a deep, sustained demand for hard assets, perhaps driven by that strong growth and underlying liquidity.
Let's wrap up with the market movers, the individual stocks making headlines. There wasn't a party for everyone. GE Aerospace took a hit.
Yes, GE Aerospace dropped over 7.00%. They beat quarterly forecasts, but investors focused on the signs of decelerating growth in their commercial engine division. It's a classic case of good isn't good enough when expectations are high.
Abbott Laboratories also struggled.
They led the S&P 500 declines, down more than 7.0%. Their fourth quarter net sales of $11.46 billion missed analyst expectations. The market punished that miss severely.
But on the positive side, Meta Platforms had a great day.
Meta rallied more than 5%.
That was ugly. Ubisoft plummeted 36.60%. They announced a major restructuring, studio closures, and canceled 6 titles. That is a company in deep distress, and the share price reflected that uncertainty.
On a brighter note in the tech world, Samsung SDI and Alibaba had strong showings.
Samsung SDI soared 18.67% in Seoul, leading that regional tech rebound. And Alibaba popped 5.00% on reports they're planning an IPO for their AI chip unit, T-Head. Again, the AI narrative driving value unlocking.
And finally, Datadog.
gained 6.00% on an analyst upgrade to buy. Expectations are high for their fourth quarter growth.
It's been a fascinating day of recovery and realignment. The market shrugged off the fear and chased the growth.
Exactly. The ability to look past the political rhetoric and focus on 4.4% GDP growth shows strong underlying confidence. We'll have to see if this momentum holds as earnings season continues, but for now, the bulls are back in control.
We will be here to track it all. If you find this useful, please follow Market Brief After Hours. Thanks for listening, and we'll catch you next time.